What happens to financial markets when a war breaks out? Do investments collapse? Or does it become a once-in-a-lifetime opportunity? As tensions rise in Iran, the impact is not limited to politics or security alone. It quickly spreads to the heart of the global economy, where markets react instantly and often violently. The first thing we notice is fear and uncertainty. This pushes investors to move away from risky assets like stocks. As a result, global stock markets often experience sharp declines, especially in sensitive sectors such as technology and travel. But at the same time, other assets begin to rise. The most important one is gold, which has long been known as a safe haven. When investors are afraid, they turn to gold to protect their wealth from volatility. Oil also plays a major role in this equation. Iran is a key player in global oil production, and any threat to supply can quickly drive prices higher. This affects the entire global economy, from transportation costs to the prices of basic goods. We also cannot ignore the US dollar, which often strengthens during times of crises, as it is considered the world's most stable currency. In other words, war doesn't just destroy markets, it reshapes them. During these moments, smart money begins to move. While some investors panic and exit the market, others step in searching for opportunities. This is where the difference becomes clear between an average investor and a professional one. History has shown that every crisis carries hidden opportunities. The problem is, only those who understand how markets behave under pressure are able to see them. So if you are only following the news, you see risk. But if you look at it from a financial perspective, you might see something completely different. The real question is not what is happening. The real question is, what are you going to do about it? So the real question is, how do you actually trade during times of war? First, you need to understand one simple truth. Markets during war are driven by emotion, not logic. Fear, uncertainty, and sudden news can move prices faster than any technical indicator. That's why your strategy needs to adapt. There are three key assets that traders focus on during geopolitical crises. First, gold. Gold is considered the ultimate safe haven. When uncertainty rises, demand for gold increases, often pushing prices higher. Second, oil. Any tension in the Middle East can disrupt supply chains, which directly impacts oil prices. Even rumors alone can cause sharp spikes. Third, the US dollar. In times of crises, investors tend to move their money into the dollar, seeking stability and liquidity. Now here's the important part. It's not just about knowing what to trade. It's about how you trade it. During war, volatility increases dramatically. Prices can rise or fall within seconds. So instead of aggressive trading, smart traders focus on controlled entries and quick exits. They wait for confirmation. They follow the news closely, and they avoid emotional decisions. Another key strategy is risk management. Never risk a large portion of your capital on a single trade, because during war, anything can happen. Markets can reverse without warning. Unexpected news can completely change the direction. This is why professional traders don't chase the market. They wait for the market to come to them. They stay patient. They stay disciplined. And most importantly, they protect their capital first and look for profits second. Because in times like these, survival in the market is more important than making fast money. If you can manage risk and control your emotions, then even in the middle of chaos, you can find opportunities. But if you rush in without a plan, the market will teach you a very expensive lesson. If you want to trade during times of war, you need more than just knowledge. You need discipline. Here are the most important rules you must follow. First, never invest all your capital in one trade, no matter how confident you feel. Second, always use a stop loss. In volatile markets, price can turn against you in seconds. A stop loss is not optional. It's essential. Third, stay updated with the news. During war, a single headline can move the entire market. Fourth, control your emotions. Fear and greed are your biggest enemies. If you trade based on emotions, you will lose. Another critical mistake to avoid: overtrading. Many beginners think that more trades mean more profit, but in reality, it often leads to more losses. Professional traders don't trade all the time. They wait for the right opportunity and act with precision. Also, don't blindly follow others. Social media is full of opinions, predictions, and noise. What works for someone else may not work for you. Build your own strategy, understand your risk, and trade with a clear plan. Remember, during war, the market is unpredictable, so your goal is not to win every trade. Your goal is to stay in the game. So, is war a danger to the market or an opportunity? The truth is, it's both. For some, it brings losses and panic. For others, it creates opportunities and profits. The difference is not luck. The difference is knowledge, discipline, and strategy. If you understand how markets react under pressure, you can position yourself ahead of the crowd. But if you follow emotions, you will always be one step behind. So the next time you hear breaking news about war, don't just react. Think, analyze, plan. Because in the world of trading, those who stay calm are the ones who win. If you found this video helpful, make sure to like and subscribe for more content like this. And tell me in the comments, do you see war as a risk or an opportunity?